thanks for joining this session. My name's Dave Wilson. I'm currently chairman of LBG Lab Bible Group Media, which we IPO'd in December. I've been working with them for 3 to 4 years. I'm also non-exec director of another AIM-listed business, which is Music Magpie. Prior to that, I spent 13 years at GB Group, or GBG, which is another AIM-listed, and grew its market cap from about 17 million up to about 1.8 billion through 15 acquisitions. And then prior to that, I've been in 4 private equity-backed businesses, first of which when I was 26, actually, so only a couple of years ago, when we raised capital and then trade sold to Fujitsu ICL. So I've had experience in both PE environments, albeit quite a few years ago, and more recently in the the listed environment. So what I'll talk through is probably 3 or 4 categories. The types of shareholders, what they look for, the types of experiences that you come across in those environments, how the value dynamics, the personal wealth creation works in both environments, and then just a quick summary, and then open it up for questions. So I think in both the private equity and if I call it AIM because it's quicker, or listed or AIM environment, all shareholders are looking for a big market with growth opportunity, something unique about the business, with moats or barriers to entry as a protection mechanism over a period of time, and a good and proven management team. So they're the 3 fundamentals that are consistent in a listed environment or PE backed businesses, or businesses that are looking to raise PE funding. So if I just cover the private equity side, first of all, I've checked this out with quite a few mid-market PE firms, and the large American players as well are not dissimilar to this. Is that what they look for in terms of financial returns are 2 times money back in 3 years, or 3 times money back in 5 years. And if you translate that back to returns that they're looking for, that equates to 25% returns per annum. Yeah. So if achieving a 25% value increment per annum, either through growth or profits, then they will be very happy. Obviously, with a private equity side, then they tend to, on their thesis or investment paper, assume the same exit multiples as the entry multiples, but they always look for upside to increase their value returns. In the PE side, I would categorize it and say there is a higher degree of oversight and management, and they will introduce best practice on financial management, procurement, IT systems, etc. So before going into either of the environments, it's really important to have a lot of the background information, financial KPIs, and key numbers already churning over within your businesses. Because if you go to either of those environments, as soon as you're in the environment, you will be requested a lot of information. So before entering, particularly the PE side, you've got some time in the AIM market, or try and get all of the background systems to be as high class and immediate as possible. The interesting thing I found with the PE side, I'm still on the PE category, is that they're obviously looking for a 25% return, but what they try and do is to try and de-risk that. Yeah, so they'll do that through high level of leverage, debt leverage, and other mechanisms like sweet equity to encourage the management team to deliver better returns, and therefore, we'll de-risk it for them individually. So that's a bit of a nuance. The other is that, depending on the private equity firm, you'll either have 1, 2, or 3 of the people sitting on your monthly board meetings. So typically in background, they will be very analytical. So you've like got an analyst talking in the board meeting, either via your chairman or the operating director of the PE environment in every single board meeting. So you have to be on the pulse with all of your numbers, know all your numbers inside out, back to front. I know this is pretty standard, but it's quite intense in the PE environment. So that's a bit of a summary of the shareholder on PE side. Flip over to the AIM market or the listed environment. Their returns requirements are typically less for over a 10% return, just as an overgeneralization, or over your weighted average cost of capital. Well, I'm getting some feedback here, so just wonder if people can go on mute if you're not. Yeah, thank you. So typically that equates to about a 10% return, more than a 10% return. Now, with the AIM environment or the listed environment, the fund managers have to select from around 2,500 businesses where to move their money from and to, and they're assessed on their monthly performance, their quarterly performance, their half year, and their full year. So it's quite pressurized from their perspective. So they have to believe the long-term story of the business, and then they have to choose which businesses they choose to invest in. So a large amount of companies they've got to select from, and therefore they have to be very picky on the businesses that they choose to put 5-10% of the shareholding into the business, and that can range from in my GBG days, we had people putting in offers for 50 million, just straight check. 1 week later, in Lab Bible Group, similar thing, key offer was like 60 million single check, from the big fund managers. They have billions under capital, so they really have to assess the management team and look at long-term growth potential of the business. So in summary, then again, many businesses you've got to choose from. They can come in and out of businesses fairly easily, and they have to really see the long-term value gain in the competitive marketplace. So if I then just switch over to life in both worlds. So life in the AIM market or the listed environment is you have more time outside of the company. What I mean by that is you speak to more advisors, you'll have your nomads or your brokers, you'll have your financial PR firm, and you'll have investment banks to talk to you. So more of your time on a day-by-day basis is spent outside of the business. And you either like that or don't, but you can learn from many of the advisory businesses that are out there. The other thing is that a lot of the choices are in the hands of the exec team, because on the AIM market, you only have to see the shareholders every 6 months. There's various other events where you can pitch to them. So effectively, you have to perform on each 6 monthly cycles, and it's really all around expectation settings. You always have to perform above your expectations. The typical examples is if you miss an expectation or a consensus in the marketplace, your share price can drop 30% or more. There's also factors outside the environment, like the economic conditions and revaluations recently of tech stocks and consumer stocks, etc., that can damage the value of the business and your own personal value in that. So I said the key thing: get more time outside the business. You're more in control of the business, but you're constantly pitching for continued investment and from new investors. In the PE environment, the way I look at it is your lord and master is sitting on the board meetings every month. So that you have to, the type of more pressure, because you have to, prove that they made a good investment and keep them on board. And there's a higher risk to yourselves as CFOs, because typically if the business is not performing, then it's typically the CFO that is, more vulnerable on that basis. The focus in the board meetings are very analytical in the PE environment. Some people like that, some people don't like it. So the key thing is that I call it like your lord and master, the director or the independent chairman, however it's governed, is there every single month. I didn't actually cover the AIM side, which is typically the board meetings are for the larger companies every month. For the smaller companies, it can be every quarter. Typically, there's somewhere between every quarter and every 2 months. So the AIM, I keep calling it the AIM market, is the time that you will need to spend in the CFO of that is probably anywhere from 3 years up to 9 or 10 years. So you really got to be thinking that far ahead. Say, am I enjoying the team I'm working with? Am I enjoying the environment I'm in? And am I enjoying the business? So, for a long period of time, because if you can't really swap yourself out as a CFO from one business to the other that regularly. Yeah. And on the PE side, you will typically have a 3 to 5 year exit horizon. So, if you exit after 3 years, you sell to another organization, and you're probably locked in for another year. So your timelines in the PE environment, to work is less than the listed environment. Then just moving over to to sort of the personal wealth creation. I've tried to get different people to give me figures on this, but typically on a PE type business, the averaging, I think, is around 2% of the value of the business. So if you've got, a business that's growing from either you're paying it or you're paying for the capital yourself, or you're taking share options, your exit valuation for you individually is circa 2%. But the range on that is 0.5% up to 3-4% typically. If you can leave us some higher value for yourselves or higher share options, then all well and good. And that tends to be with the CEO prior to bringing on the PE firm. On the AIM market, typically what happens is you have the remuneration committee, and what typically happens on that is every single year you will receive approximately 100% of your salary in long-term incentive plans. Now, they typically are performance-based, and that the governance of that is really down to the chairman and the Remco chair, and therefore the bias of those individuals and chemistry of those individuals back within the board are really important, because you can get somebody that is really aggressive and sets high performance metrics, or somebody that is less aggressive where the performance metrics and the ability to earn value is lower. So that chemistry is really important. But every single year you can get 100% of your salary, and then the following year 100% of your salary, and the year after that, and the vesting periods tend to be 3 years. So over time, assuming a share price growth, then you can make a significant amount of money. And also that you can sell the shares as well. You don't have to keep the shares, because you hear on the market around us like it's bad news if a CEO or CFO sells the shares. But people have mortgages to pay off, people have tax to pay, things like that. And the market accepts the fact that you can sell your shares. So you're not locked in for 9-10 years on your valuation. You can sell it en route. So if I then just try and wrap it up a little bit and then open up for questions. So in summary, I think the timelines in the two different environments are it's more than likely that you'll be in the main market or the AIM market for a longer period of time, 7 to 12 years type environment. Within the private equity, it's 3 to 5 years. So really how you're feeling in your current business, do you want to be around the people you're working with? Do you love the business? They're quite important characteristics to consider for your next period of growth and development. Higher returns expectations from the private equity, 25% versus 10% on the market. Therefore, if there's a higher expectation of returns, therefore there's pressure associated with that, as you would expect. And probably the key thing for both environments are that the chemistry of your shareholders or your non-exec directors with the exec team is critically important. We all know this. So if you're in a private equity environment, choosing the right partner or director from the PE firm to fit the chemistry of yourself and the CEO and the wider team is critical. And you do have choice. You have more choice prior to the investment, but you can choose who should be sitting on the board. Don't think you can't choose that, because they want the business to work and therefore they know the chemistry is really important to work as well. You also have a choice of a non-exec chair as well. And typically the private equity, if they need an independent chairperson, will put a number of people in front of you. So you do have the choice of whether that chemistry works or doesn't work. Similar thing applies within the listed environment or AIM environment. You have choice of the non-exec directors. Typically what would happen, there's a nominations committee that has the chairman and other non-execs in it. And the nominations committee will really want the CEO and CFO to be comfortable with the particular non-exec director. You'll be involved in the interviews, and if it's an open, transparent type board, then you'll have a choice in that. You can strongly say, really don't think the person suits, or strongly say, this is a great person to help us to the next stage of the board. So I think that's probably how long we've taken on that. 20 minutes, just over 20 minutes. That's probably as much as I can pass over, sharing on my own experiences in a summarized format rather than a detailed format. So if I can hand back to Chris, and please lodge some questions in the chat box. I don't think I can see the chat box. I'll have to rely on Chris to read it out to me. And then after that, if we've got time, then please raise your electronic hand.
So we've got a question from Jonathan Richards. I think it's Richards. Can you bring to life some of your experience of DD as part of the process for PE and AIM?
Wow, yes. So on the PE side, they go very, very deep on searches, information about the exec team. And what I rightly or wrongly did on the PE side is, knowing their base expectations for a 25% return, then if I could see we're going to do 30%, 40% over that time period, I'd downgrade the numbers to 26%. So I fix the numbers on a low return, because you make more out of doing that and you get a better relationship. So the modeling is really, really important. And on the PE side, their own people will do that, or they get an independent firm to do that. They'll do more research on the competitive environment and the market environment, so they become pseudo experts themselves on the PE side. So it's more in depth, looking at the competitive environment. They will ask you for who you will exit, who you think you can exit the business to, because then they'll look at multiples of the buyers of this business to see how they're valued. So they go in a lot of depth, but it's all around the competitive environment and the individuals on the business and the business plans. And I would say the timeline on the due diligence is shorter with private equity. On the listed details, you have to do your admissions documents, and you have your what's called an FPPP, which is like your accounting systems have to be checked, your policies have to be checked, your financial models have to be checked by a third party, and the Nomad, if it's on AIM, will also do an individual check on yourselves, and you have to do a declaration to say, you've not been in a business that has gone into liquidation, or if you have, then you have to say you're part of it as well. So it's a similar type of background due diligence on the AIM market. When you're coming towards the IPO, what typically happens is your Nomad or broker will line up businesses, what's it's called different things with different Nomads, a pre-marketing. So you'll see, somewhere between 5 and 15, you'll pitch to 5 to 15 investors, get their feedback to see whether they're interested in whether the valuation dynamics or the business are right. And then when you come to the full marketing roadshow, typically it takes a week, where you have, in the virtual environment, 8 meetings a day, every hour. So it's quite draining. At the end of that week, you're really drained on it. But the overall timescales for the due diligence for the marketplace, I think you can wipe somewhere between 4 and 6 months of your working time out, and that tends to sit on the shoulders of the CFO.
Cool, thanks, Dave. Vic, do you want to? You put a question there. Do you want to just expand on that and pose that to Dave? Sorry, Vic. Vic Mystery. Can you hear me?
There we go.
Yeah.
Sorry about that.
All right. I thought I'd just hand over to you. I don't want people just hearing my voice all.
Okay, Dave, I'm just about to, I'm involved in a startup right now, and we're considering implementing a slicing pie model prior to investment. And I don't know quite what reaction that's likely to get from anyone that's looking at an investment.
A what model? I didn't catch the wording on it.
Oh, sorry, it's called the slicing pie model. It's basically a way of allocating shareholding to the founders and the people that work in the business, so that where they are working literally just for sweat equity to start with, their position is protected. But what I'm keen to understand is, if we use that model, what happens when we actually get an investment round coming through, because that will clearly dilute the the investment and the allocation of stock to the founders.
Yeah, it's first of all, from a if it's startup, then the preference from venture capitalists or private equity will be to have a relatively small capital table, or cap table, you call it. And if it's a widely spread one, they will just look at that as saying relatively complex. Dilution will affect everybody, obviously, for people coming in. So I would just test out to see, is it better to have options for the employees ahead of the founders, post investment, rather than have the slice pie, or as you said, ahead of the PE. So my instincts would be to say, try and get the wider ownership to employees, which depending on the private equity or venture capital will either prefer or not prefer, because some people just say, just make certain the top people are looked after. An organization will say, let's make the whole, workforce motivated on the exit. So the more call it modern's the wrong word, the more up to date VC private equity will share the ownership, but have a focused position with the exec team. So just to summarize that, I'd say it's better to talk through because they'll have a preference, and you can use that as leverage with the PE. But I would suggest it's best to split the pie through share options post investment.
All right, brilliant. Thank you.
So just going through the chat box there, Andrew Maddox, do you have a question?
Hi everyone. Yeah, it was just basically in terms of if you're ever joining a company owned by a private equity household, is how much due diligence would you do yourself with regards to the quality of the private equity house that you'll be ultimately working for?
I think it's all time dependent, Andrew. So I would say that the key due diligence will be get to know the people that you'll be working with post investments. I mean, really get to know them to make certain the chemistry works on that. And the other factor is speak to some of their portfolio companies to see that their experiences of the particular individuals that you will be dealing with are like. It all comes down to the 2-3 people that will be talking about your business within the private equity environment. So that chemistry and what the individuals are like are really important. And if their preference is to have an independent chair in the business, then that is a really critical appointment as well. So I'd say a lot of due diligence over portfolio, talk to other portfolio companies, and about the characters and chemistry of the individuals on the business. The other thing I missed out on that is ideally you would need to know which fund it's sitting in, because quite a lot of the PE funds have a 10-year period on it. So in other words, if they're using a fund that is 8 years through the 10-year period, there'll be pressure on exit within 2 years. If it's just a new 10-year fund, then there'll be no pressure on exit. The exit will be at the right time to suit the business. They will definitely deny that, but they all do that, because they try and utilize, money that's not working from them on one where they can flip it or, make money out of a business in the short term. So 3 points there. I rabbited on a little bit. It's chemistry of the individual's concerned. Definitely the portfolio companies, don't just speak to one, speak to 2 or 3, and the ones that have those individuals on. And then the third is which fund is the investment coming from.
Brilliant. Thanks, Dave. And then James Drace Francis.
Yeah, hi, good afternoon. Hopefully the question's fairly self-explanatory, but just wanted to reflect on experiences I had over a few years. Lawyers, pretty good. So talking about advisors generally to a next quoted PLC, so slightly below AIM, you didn't require all of the process of an AIM listing, but you still had an advisor, a broker, you had auditors carrying out the full PLC. They were particularly difficult with accounting policies. And you've found also on the fundraising side, everybody wanted to have a retainer, everybody wanted to have their expenses paid, everybody wanted the upside if money came in. that you did not have a proper alignment of interests. And eventually we went unquoted because the cash flow, these guys, all of them thought they were top of the creditors stack. And they were very aggressive about collecting fees, even when they hadn't done the best job. We found it very hard to find advisors where there was a genuine alignment of interests. So rather than protect themselves and collect their fees, they actually want you to present the best business case. They want your share price to go up. They want your business to grow. They want you not to be, troubled by the various day-to-day issues of a PLC that I have to say was slightly cash-strapped. But what are your experiences there? Anything you can reflect on? Clearly, when you talk to PE, it's a huge advantage being private because you don't have to worry about all of that. But what are your views on the advisor relationships for a PLC?
For a PLC, yeah. So I think last year I did 2 IPOs. One as chair and one as an ed. One which is Music Magpie. The selling shareholders wanted too high a value, so there's nothing in it for the fund managers to make money over the long term. The other one was the Lab Bible Group, which is the pricing was just right. We've had a 15 to 20% increase since IPO in December. So I'd say if you come into market, you have to, the fund managers have to be able to make money out of your stock, because if you try and price it too high, they won't make money. Therefore, you will have big demand for it. The way I looked at the fee side is that first of all, pick the best advisors. Secondly is that you can cross-check on their fee structure. They tend to be a percentage of the equity raised or enterprise value, depending on which position you're in. And I sort of squared it off on the basis that if you raise enough capital on the market, that capital, some of that capital is then used to pay off the fees. So make certain you raise more than enough to pay off the fees. And the other way I square that off is just to say it's an exceptional item anyway. So if you're raising capital, raise enough to pay off the fees. Therefore, don't worry, just get the best advisors.
Okay, thank you.
Mark J. Is Mark still with us?
Yeah, I'm still with you. Hello, can you hear me?
Yeah.
Hello, everybody. Thank you. This has been very useful today, very interesting. So some CFOs/FDs are
I've just lost
companies. Sorry, I've got very poor reception up here.
I heard some CFOs and I lost you just
Have you are parachuted in investee companies by.
Sorry, Mark, we can't hear you, but I have got the question that you posed. I'll just read it out, might be easier.
Okay. Yeah.
Many FD, CFOs are to potential investee companies in PE. Have you experienced thoughts of that way of entry?
Yeah, it's I'm quite like a people's person, and they tend to they'll have some experts. The PE will have some experts that will, if the business isn't doing that well, they'll bring people in to help the business out, and that just gets in your way. And if a CFO has been released from a private equity business, and I was being, call it parachuted in, I would really do additional due diligence, because there's very few CFOs I think are poor. Some are, obviously, but there's sometimes other reasons why the incumbent CFO has been exited. And it's not just speaking to the exec team or the board or the PE on that. And the answer may be, felt they just weren't good enough. So then you've got to flip it and say, well, what does good look like, and why? What weren't they good enough? And so I would just say overall, if that scenario has happened and you're being parachuted in, then just be a little extra careful with it. It may just be a super opportunity that is like, well, I'll give it a shot anyway, but you just have to, listen around a bit more than the board and the PE, like talk to the team and, the finance team as well. I don't know if that's answered the question or it came from the right perspective. I'd just say act with a bit more caution, I would say.
Thank you. That's very useful. That answers the question. Thanks.
Brilliant. And Andrew Gorman.
Hi, so I was just dropping in the question to get your view on US versus UK listing. So we're a life science company. So done Series B, looking IPO maybe 2-3 years out. Majority of the market is US, and the default answer seems to be NASDAQ, but I appreciate a little bit of color and whether or not that is necessarily the right view.
Yeah, that's a great question. So in summary, I'd say the valuation dynamics in NASDAQ are significantly higher than the UK markets or European markets. So the valuations will be higher. Alongside that, if the valuation's higher, the expectations are higher. So that's point one. The second point is if you're on NASDAQ, then the investor community typically is either New York, Boston, Chicago, but can flip over to California, depending on where the key investors are. So you as CFO and your CEO will spend a lot of time there. You may already do that, but if not, you will spend a lot of time there. The second thing I found through, we had about, in GBG, we had about 25% US investor holding. What I found is that the New York investors are extremely aggressive, very direct questions, what your business is going to look like 10 years, what you're going to do this. So they're firing question after question after question. And it takes a bit of getting used to, but as long as you respond openly, transparently, they tend to be okay. But that is just a shell shock compared to, UK fund managers that tend to be all professional and all courteous and things like that. In the New York area, they're very, very aggressive. If you flip that over to the West Coast, overgeneralizing, I know that they tend to be more creative, more long-term thinkers. And then if you look at Chicago and Boston, it tends to be more of an intellectual play when you're pitching to investors. So I'd say try and trial it out. So if talk about NASDAQ, again, talk to a couple of businesses in your space, and just talk to a couple of the investors prior to any pre-marketing that you may do, because you'll get a flavour for what they like. But in summary, you'll get a higher valuations, but alongside those valuations, there are expectations that come with that. And also, I talked to earlier on at the top of the call around, in the UK, there's 2,500 businesses that fund managers look at. In the US, NASDAQ and others, there's something like 30,000 businesses. So if it's an early stage and your market cap is relatively low, you will not get access to, the funds that you probably need to get access to. So choosing the right broker on that is really important, because, they have significantly higher funds to invest. They're in the billions all the time. Why would they see a business of $200 million or $400 million? Their threshold tends to be at $1 billion. So when GBG market cap moved to that level, I got more interest from the US side. So they look at the valuation dynamic and also the volume traded. So the volume trade on daily, but what they look to do is if they place, can they get $5 million out a day? So they're the two key thresholds, $1 billion valuation, and can they trade out $5 million a day? Overgeneralization again, but there are a couple of, straw bits.
Thank you. That's really helpful. Just one follow-up. Did you find SOX to be onerous in terms of the additional systems, processes, etc.?
We didn't go across to a dual list on it, chose not to, but the people that I've have spoken to over there say the burden is unproductive and is a burden, a big one. So I come down to if your business model is simple and your authorization processes and your decision makings are simple, then it'll be less of a burden. If it's a complex business with high judgmental, it will be a high burden.
Okay. Thank you very much.
Thank you.
Ian Snelson.
Hi, thanks, Dave. I understand a lot of what you've been saying. Obviously, it's a very high pressure environment, etc., particularly within the PE field. I've had one experience with a PE company where I was the finance director of the company. We got bought by a PE house, and then I spent 4 years being the managing director. We were one of company of 6 that they bought across Europe. But unfortunately, some issues with some of the other companies meant that the overall fund that we were part of didn't grow. So when they were looking to exit, they were trying to maximize their returns. So they did 2 things towards the exit. Firstly, they restructured it, all the shareholding. So the money that us as managers have put in got messed around with, to say. I'll come back to the second. The other thing is they demanded that we cut our costs across the whole of the business by about 20%, which basically destroyed any chance going forward. It was like falling off a cliff. And I know that since that was 2 years ago, since then the business is a fraction of what it was, but they maximized their value. So they sold it onto another PE house. And as a result of what they did with the shares, our investments were basically valued at 0. So there is a risk associated with that. But our investment was put into 50% as loan, 50% as equity. And basically we got told that our total investment, and in my case was a significant amount, was worth €1. So it's like, okay. But I know the PE company that bought them is also looking at taking legal action because they were, the business that they bought wasn't what they thought it was, because of the decisions that have been made to try and maximize the profit. So they maximize the profitability, but cut away all any potential future growth. So suddenly, the point is basically there are risks associated with personal investments in these things. So, but yeah, it's a very high pressure environment, but you expect that, and that's fine. So you can manage that on a day-to-day basis, but I just want to make the point that it's not all necessarily growth from your personal point of view. There is risk associated with it.
Yeah, and I've had one of the PE businesses, similar thing happened with that, and you don't have a lot of options on that, and if you're the PE that it flipped over to, tries to sue the original PE business, the warranties, indemnities tend to have to be given by the management team. So you won't be in a good position on that, as you know. So it's one of those awful situations. And could you have done anything beforehand? Probably not, because it depends in the lifestyle, the life cycle of the PE business, and you wouldn't have known about those other businesses, not doing well, that then cause stress on your own. So unfortunately, I think it's just one of those awful things that can happen. So I agree with you.
Yeah, it might be an exceptional circumstance. I think generally speaking, probably very positive. But it's just that sometimes things don't go according to plan, and it can go quite badly, not according to plan, so to speak.
Yeah, sorry to hear that, Ian, but I hope things work out for you. Yeah.
Then we've got one last question from Paul.
Yes, thanks, Chris, and thanks, Dave, for a really interesting presentation. My question is around secondaries. I just wondered if you could give a few thoughts on that.
Secondaries are being
As in secondary purchase on shares
from
one PE house to another.
From what, sorry, Paul?
From one PE house to another.
Do you mean that the whole business
for the first time?
The whole business flipping, or a number of the shares flipping? So you add another PE in, or a total flip?
Partial.
Partial. Yeah, I guess the same rings true for the original PE house, doesn't it? You would, if allowed, want to know whether the new PE house fits in with what you're trying to do with the business. If it's done without talking to yourselves, then and sometimes they'll retain the right to do that anyway, then it's just more difficult. So I guess on the positive side is, if the partial sale of the equity is into a PE house that has experience in your marketplace, then you can tap them up for knowledge and experiences. But it really comes down to how much is in your control and how much is outside of your control on that. And sometimes if it's moving over to another PE house, then they may be able to give you additional funding over time, depending on where it sits in their portfolio. So I think I'm thinking out aloud here, really. I'd probably say it's like, if it's within your control, similar due diligence I talked about beforehand with it. If it's not within your control, just talk openly with the PE house to say, this new holder, shareholder, needs to be adding value to the business, just to try and steer them down the path that can help the business, not to de-risk it from their side.
And do you think that the new sort of PE house has a right to due diligence, or do they just have to buy effectively on the open market?
Well, I think that the new PE would want to talk with the exec team, but all of the existing PE due diligence will still be valid and maybe slightly out of date. Mm-hmm. So I think they don't have the right unless it's within the the shareholder agreement. But I think they'd want to, and I think as an exec team or management team, you probably want to get to know them anyway. But I think you can draw the line rather than just say, do the once over of us totally.
Thanks very much. That's helpful. Yeah. I think that does echo some of my thoughts, because as you observed, diligence is a big deal.
Yeah. Agreed. Thank you.
Brilliant. Well, thank you so much. We've come to the end of the questions on the chat box. I don't know if anybody else has got anything they'd like to add, or just even if it's a discussion point to raise. If not, we can think about closing out.
Well, thank you for taking the time, everyone, and let me know if I can help with anything. Chris could give me the contact details, or if you want to email, it's davejohnwilson@gmail.com. So if you want to email me, I can try and help you out. If I can help you out in any way, then please get in touch.
Thanks so much, Dave. Really appreciate you taking the time out. So it's been really insightful and really interesting. So we really appreciate it. Thank you. Hopefully everyone's enjoyed it. We are going to have themed sessions going forward on the main. So next month will be the 23rd of March. You'll receive details after this call, and it's going to be more around employee engagement, employee retention and attraction, because the last few boardrooms had centered around those kinds of issues and challenges. So thanks everyone for attending. Hope you found this useful, and we'll see you next time.
Thanks, everyone. Take care. you.